Hey guys, Chris Parks here, Atlantic Coast Maury. Just wanted to share with you some numbers real quick on how to help a marginal buyer get past this. Just in case your loan officer doesn't know how to do this, you can share this with him or you can call me and I'm happy to get them pre-approved and help them with this scenario. So here we go right here. So based off of this is the one that we're going to be starting with right here, which is a $400,000 down with 5% down. So starting right there, that's your purchase price. That would be your typical down payment, and this would be your monthly payment based off of exactly everything that's listed right here. And your cash to close would be $30,000 and change based off of this 5% down. Now, let's say the home appraises for $10,000 less. Now, you're still buying it at the $400,000, but it appraises now for $10,000 less. From the bank's perspective, what that means is that now you're actually buying the home for 390 and you're paying the difference up to the 400. So they're going to be putting the down payment based off of this. Now, in order to make this work, if you did it based off of a 3% down, now this has to be a first-time home buyer for this calculation right here. If you're a second-time home buyer, you can do that, but you have to maintain a minimum of a 5% down. So the numbers would fluctuate slightly. That means that you would need, off of the down payment of a $390,000 home, you would need $11,700. So if we go ahead and subtract from the 390 the 11,700, that means we need a loan amount of 378,300, which you can see right here. I've already updated that. So this is what they would be ending up with. Here's your purchase price that hasn't changed. The appraised value came at 390. So now their loan amount is not too terribly far off from the original one. Interest rate is about the same. You come down here, look at the payment differential. Not a whole lot there. Look at the cash to close differential. It's less than $2,000 difference between the two. Okay. And the payment difference between one and the other is $24.75. Not a huge difference. Now, let me show you how I did it. If we go over into the more information button over here, you can see that the biggest change is right there in the mortgage insurance. The mortgage insurance is about $30 more expensive. And that's what's causing this to happen. Now, if you go over to the closing costs, you're going to see that the APR, non-APR, prepaids, all this stuff remains about the same. The only difference is when you come back to the main screen right here, is that your cash to close is about a $2,000 difference. Now, this is a very good strategy. I've actually employed it a couple times now. I'm trying to release it with the rest of my buyers so that they can get out and be successful in a market. And so obviously, gapping the appraisal or having the ability to gap the appraisal certainly does help. And I'm certainly happy to help you or your clients. Never too busy for your referrals. So thank you so much for the opportunity.